Hi, now we are going to discuss about issue forfeiture and the issue of shares. First, we will understand the concept part and then we will know the journal entries and then we'll do some practice. So let's get into the concept part first. Before getting into the discussion, let us understand what type of question comes in the exam. Usually there are two or three types of question comes in the exam. First type of question, what most of the time it came, is simple journal. They will ask you to write the journal. That is one type of question that you have to write all the journal. They will give that one problem. For the problem, you have to do the journal and whatever working requires you have to give. Here two important things. If it is not mentioned that narration not required, you need to write the narration. You have to give the full narration. And also you have to give wherever required full working. While doing the working, don't write any shortcut, abbreviation or anything. Write the full because that has a weightage in the exam. Now, another type of problem comes, they will give journal and some other account. Usually they give capital account and forfeited shares account. These are the two important account in company accounts. So that they give. Next, this is also common. They ask for a cash book and necessary journal. Apart from that, sometimes they give show the capital account in the balance sheet. Kind of you have to draw the extract and show it to the balance sheet. Now, if they give this cash book and necessary journal, now cash book, what type of entry comes? Only receipts and payments entries. Receipts, application money, allotment money, call money, and issue. Expenditure part, if there is any refund is there, that will come in that. So those receipts and payments will come into the cash book. Now, once you do the cash book, don't make the same entries again into the journal. So when they are giving you cash book and necessary journal, write the cash book and then other entries you make into the necessary journal. Other entries are what? Transfer entry, the due entry, allotment money due, call money due entry. There could be calls in area entry, forfeiture entry. If there is any forfeiture, there will be reissue, but reissue money will come into the bank book. So that will go into the cash and bank. Capital reserve entry, all this will come into the journal. So basically, receipts and payments goes into the cash book, the rest goes into the journal. So now let's get into the topic. First, we'll try to understand what are the types of categories of share capital is there in the balance sheet. You heard of authorized capital, issued capital, subscribed capital. What are they? Authorized capital is the total amount of capital what the company thinks in its lifetime. Promoter thinks that in its lifetime it has to be raised. It is the total capital company can estimate that they are going to raise over the life of the company. Depending on the nature of the business, board of directors will estimate preliminary expenses, working capital requirement, how much to be invested on the assets, all those things. Based on that, they will arrive this figure, and this figure will be given in the memorandum. It will be in the capital clause, and that will be approved by the ROC, Register of Companies. So that amount is called authorized capital. It is the total capital in its lifetime what the company can raise. Next comes to issued capital. Issued capital is to that extent out of this total authorized capital, to that extent it is issued to the public for subscription. Total capital over the lifetime, it has to be uh, taken. Company may issue in piecemeal various terms. So till date, to that extent what is issued, that is considered in this issued capital. Now after issuing, subscriber will subscribe. So out of the issued capital, how much is people have subscribed, that will come into subscribed capital. So all this authorized capital, issued capital, subscribed capital, it will be shown as at face value or nominal value or par value, whatever. These are all same. So basically it will be at par shown in the balance. Now balance sheet, only the paid up capital will come, rest of the item will come as a notes. So after subscribed capital, what it comes? It comes called up share capital. Called out of the total people will subscribe if the company issue the shares in installments, we'll discuss subsequently. Then full money will not be called, but the people will apply along with the application. Whatever amount they subscribe, out of that, how much is company called? There could be only application money was called. After that, only allotment is called. So if the up to allotment is called, so to that extent money called will come into that. How much is paid by the people? That comes into the paid up capital. So company may be called up to allotment, but in that some shareholders may not pay the allotment money. So whoever paid, whatever amount is paid up, that comes into paid up share capital. That is called paid up share capital. This paid up share capital is the amount which will be shown in the balance sheet in the liability column. There is another term called reserve share capital. Reserve share capital is such that if the company law allows that if the company decides out of the uncalled amount, certain portion will not be called and it will be called only if required during the winding up or liquidation. Then that amount has to be booked somewhere, and that will be booked as a reserve share capital. It is the amount which company has decided not to call. It is out of the uncalled. Whatever called, it will come into the account. Whatever uncalled, out of that uncalled amount, certain portion, company may decide that they will not call it further. They will take it only in case of winding up. So that amount will be shown in the reserve share capital. This reserve capital is different from capital reserve. Capital reserve is created out of capital profit, whereas this reserve capital is the capital which is not called, and it is decided to call only in case of winding up. Now this we have discussed, that as only paid off share capital is taken into account for the liability side. That only in the amount column it will be reflected. Rest of the amount will be shown in the balance sheet as a note. Now let us understand the types of share capital. Usually we know two types of share capital, that is preference share capital and equity share capital. Now equity share capital is something where the promoters first created, do that. So, but preference share capital is kind of a fixed dividend bearing capital, and there will be certain fixed rate of dividend will be there. That is called preference share capital. The preference share capital has couple of different categories. The most common is cumulative preference share. In India, if otherwise not stated, it will be considered as a cumulative preference share. Cumulative preference share is what? These preference shareholders will get a fixed rate of dividend, and they will have a right for this dividend on the current profit as well as future profit. Means what? For any reason in that particular year, if the company is not in a position to declare dividend, the company has made loss, they will not declare dividend, and this dividend amount what is payable to the preference shareholders will accumulate. Next year it will be added and it will be paid. So because it is getting accumulated, it's called cumulative preference shares. Equity shareholders, so they get dividend only if its company declares. They don't have any right that they will get it. But cumulative preference shareholders will have a right to get the fixed dividend what is mentioned in their preference share. Because it can be paid in the future year and get accumulated, it's called cumulative. The other type is non-cumulative. Non-cumulative means it will not be carried forward. Means if in a particular year for any reason company is not able to pay the dividend, it will lapse. Next year it will not accumulate, and next year profit it will not be declared again. Participating preference shares, those if it is mentioned in the preference share as a terms, and these preference shareholders can participate into the surplus dividend distribution over any normal rate of dividend given to the shareholders. The normal rate will be mentioned in the agreement. Over and above the normal rate, if the dividend is declared higher, that higher portion of dividend, this preference share also can participate. That's why they are called participating preference share. They also will have a participation in case of any surplus distribution in the liquidation. Liquidation time also, if there is any surplus distribution, after the normal rate it is given to the equity shareholders, these preference shareholders will have a right. Non-participating, they will not participate. Non-participating is a normal preference share. It cannot have other than what is mentioned as a fixed rate of dividend in the preference capital. Equity shareholders can get any rate of dividend, they will not have any share on. Redeemable preference share. Redeemable preference share are those. In India, all the preference shares are redeemable. This preference shares has to be redeemed. It will have a period, and it has to be redeemed within that period or prior to that. If maybe certain date is mentioned, on that date it has to be redeemed, or prior to that means on that date company has to repay the preference share capital account amount, or prior to that. Now there are certain norms are there. In India, normally it is mentioned that Companies Act says within the maximum tenure can be 20 years. In exceptional circumstances, for some large construction project, special approval may be given for more than 20 years, but it cannot be non-redeemable. It has to be redeemed and after certain period. Next is non-redeemable. Non-redeemable means it cannot be redeemed. So it is also called a perpetual preference share. Just now I said that in India, it has to be all redeemable, then why non-redeemable? So the account. Academic purpose, you should know, some other countries maybe it is available. Non-redeemable means the capital will continue. They will not get back the capital and continue to get the dividend. Only in case of winding up, capital will be refunded. Otherwise, capital will not be refunded. Another type of preference share is convertible preference. Convertible preference share are those which at the option of based on the terms of the contract, at the option of the preference shareholder, it can be converted into equity shares. Means these preference shares will have an option for the shareholder to decide whether he wants to convert it into equity or not. If it is at his discretion, he can convert it as per following the terms of the preference share. Similarly, non-convertible, they cannot convert. It will be only treated as a normal preference share. It cannot be converted into equity share. That is called non-convertible preference share. So see you soon in the next session in a while. Till then, thank you.